Um, all right, this is going to be this is a strategy to buy stocks at extremes, and like I kind of mentioned beforehand, this is going to be about rather than giving your uh, broker or your platform a buy order in a stock below the market, like you have a level that you want to buy a particular stock. This is a way to create a little income in the case that it doesn't make it down there, and if it does, then you can take possession of the stock. So this is just a nice way to take advantage of that. This will be recorded, so please, I always mention that once you get this in your email to rewatch it again, especially if some of the theories that we talk about go over your head, or some of the things that we talk about the intricacies of options. It'll help it sink in. So please rewatch it as many times as you need, but right away is the best way to have that sink in within a couple of hours of watching this. All right, so anyway, I'll answer your questions in a little bit after we get moving on with this. But anyway, my name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now. I'm not here to tell you I'm going to make you rich or make you a millionaire, but I am here to help you take control of your finances, manage your portfolio, and most importantly, take control of your own risk. I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded stocks, financial futures, commodity futures, currencies, stocks, and options on all of those products and in all market conditions, as you can see here, kind of like what we witnessed in August just most recently. I got to get a little housekeeping out of the way before we go forward, but this is for educational purposes. This is for general commentary, doesn't constitute investment advice. The reason why I can't give you guys advice on a particular stock to buy, a particular strategy to use, is because I don't know what your risk parameters are. I don't know what's in your portfolio, and therefore what I'm talking about could be counterintuitive to what you are already doing. So take this, play around with it a little bit, and implement it into your portfolios in your own way. And please remember, past performance of any trading system or methodology is not necessarily indicative of future results. So this is going to be on calendarized laddered puts. And the benefits of this is it's a classic buy low type of strategy. Rather than scaling in on buying a stock, this is going to be using options to scale in buying a particular stock that we want to implement into our own portfolio. So in most strategies that I've talked about with options, I don't want to take possession of the stock. I don't even want my option to go into the money for the most part. So I play around using the deltas and things of that nature in order just to collect the premium. This particular strategy, we're going to be using the probabilities of an option being in the money or out of the money, however you want to look at it. And we're going to play around with those probabilities so that maybe one of our options will land in the money, but in the meantime, we're going to be able to collect the premium if it doesn't. This will overall lower our basis for buying that stock. So if we are wanting to buy a stock, say at $25 and we collect $1, we're synthetically buying that at $24 because we collected $1 in premium. We get hit or put our stock, we end up buying it at 24. One thing about options some people get a little leery about is, taking possession of those options. This is an idea where we want to implement a particular stock into our portfolio because we believe or we perceive it to be at a price extreme. So for instance, there's several stocks that have hit 52 weeks lows, and that's maybe when you want to buy into those kind of stocks. We're going to be looking at that type of scenario where we have had a big down move in the stock, and that's something we want to add. As you guys know, when you add stocks to your portfolio, the only way to get filled on a stock is to have it go against you, at least for a very short time. Otherwise, you would never have gotten filled. Well, this is a similar situation where our puts are likely to go in the money at some time in the next month or so. And if it expires in the money, then we will take possession of that. And it's because we want to own that stock. So like I said, this is a classic buy low type of strategy. And we're going to be scaling into it. Like I said, we're going to be using the options chain throughout the different months in the cycle. And I'll go into this in a lot more detail going forward, you guys. Once we get onto the platform, even though the market's closed, we're going to try and do some stuff in the platform just to show the theory behind it. And we're going to try and scale in. So we might try and buy a XYZ stock at 25, at 23, and at 20, and put that over several different months. And you know, the probabilities that we're going to be talking about is like a 33% probability of that stock going into the money, which means 67% of the time it'll remain out of the money. So we'll collect the premium for 2 out of the 3 months. Does that make sense, you guys? So we might get hit on one, take possession of the stock, but we're still going to be able to hold on to that premium for the other. Keep in mind that we may end up buying the stock. And it is an aggressive strategy. Why is it an aggressive strategy? Because we are going to be looking to buy this stock or have this stock put to us, is the way a lot of people refer to it when you sell a stock and it goes against you. When the buyer has purchased that stock, they put it to you, meaning that they want you to take their stock off their hands. That means you would have to buy it at, you know, a higher price, so to speak. And for those of you guys that have had very little options experience, a call when you buy it, you want it to go up, and it gives you the right but not the obligation to purchase that stock at the strike price you use. And a put, if you buy a put, it gives you the right to sell that stock to the counterparty at that strike price. What we are looking to do is we're going to be selling this put, and in the idea that when it goes down and hits our strike, that's where we're comfortable at buying this particular stock and adding that to our portfolio of stocks. Okay, so we're going to be looking at selling puts. And like I said, we're going to get paid to buy this stock. So what does that mean? Well, when we sell the put, we're going to collect a premium, and we're going to collect that premium, and that's going to lower our overall basis on that stock, which ultimately is going to add alpha. Now, all alpha is a Greek word for getting excess return or abnormal rate of return. When you can buy a stock for lower than where it's trading at, that gives you alpha. So this is going to be a way to increase your alpha. And when are we going to implement this? We're going to try and buy this stock at a perceived price extreme. Now, I have perceived here because you know, one person's price extreme isn't somebody else's. So this is going to be a stock, like I said, you're going to want to implement into your portfolio, a stock that you like and you believe that it's at a level where you would be comfortable purchasing it. And this stock, or this strategy, is great for the person who likes to buy and hold stocks. You know, rather than going on the platform and putting a buy order for a stock, you know, $2 below where it's trading, this is a way to sell a put on it and collect a premium. And if it never gets down there, then you get to hold on to that premium. If it gets down there, then you're comfortable buying it. But in the meantime, you lowered your basis or the price that you paid for that stock overall. And like I said, this is going to be to build a portfolio of stock. This is going to help you build a portfolio of stock, or it's a way to add to an existing stock that you have. And like I said, it's to lower the cost basis on that particular stock. Because if you have a stock trading or you wanted to buy the stock, say at $25, rather than putting that in as limit order, if we did it before it got down to 25 and we were able to collect $1 premium, you really captured that stock at $24. And you're going to have a higher return on capital because when the put gets assigned, we get a lower cost basis on it, which is increasing your return on capital. And it allows you to stay in the position longer. This is going to be when because we're doing it over several months, we can stay in this position longer, and we can keep rolling out, or we can keep adding to our duration. So if we didn't get assigned the stock in the first month, then we might sell that put in the third or fourth month going out. So we're in October, trading October right now. October, November, December is what we'd be looking at. And if we didn't get assigned this particular stock in October, we could do it in the January contract, as long as those option cycles are available for that particular underlying. And in this, theta is our friend. We want to see the time come out of these stocks, and we don't want to get filled on all of them necessarily, and we're going to be playing the probabilities where 1 out of the 3 is going to be the one that we're going to get hit on, because we're going to be looking at a 30 some odd delta, and a 30 some odd delta means that 33% of the time, so if it was a 33 delta, 33% of the time that strike will land in the money. So if you do that over the course of several months, then you can play the probabilities over the course of time that the probabilities will work out. It's just like I talk about this in Vegas. You know, if you go to Vegas and you're winning huge, the house is going to offer you another night's stay or a dinner, because they want to keep you in the casino, because they know the longer you are there, the more likely the probabilities will end up working in their favor, and they'll make their money back. That's the same thing as this. We are going to be looking at playing the probabilities in our favor, and over the duration of our trading cycles, these probabilities will work in our favor. All right, so having that out of the way, I'm going to pull it up and go to the platform. I guess, hold on 1 second. Let me pull this over here. Throw it up. I was just looking at Caterpillar. They've had a great run at it, as you can see. This isn't necessarily a stock that I want to play in, but I wanted to throw it out to you guys in a minute. So think about a couple of stocks that you might want me to look at. But this is what we're going to be looking at, for instance, and let's just pull one up that has been beaten up pretty bad. For instance, I'll just put up CAT because we had that on the line there, but I'm not necessarily wanting to buy this. But this is what we're going to be looking at. So at the top, you guys that have seen this or are option savvy will know what these Greeks are all about, but these are very important. The delta is what we're going to be talking about, and we're going to be looking at implementing the strategy in the front month with like a 30 some odd delta. Now, if you really don't want to take on the stock, then you want to go with a lower delta. You are going to get less of a premium. But, you know, if you're thinking, well, I really don't want to take on the stock, but I wouldn't mind it if it got to that level. And the more aggressive you are, the closer you are to being at the money, but you're also going to be collecting more money. But I usually like to look at to start out with the 30-ish delta. And then I'm going to look at, so that if I pick the 31 delta, I can assume that I'm going to get about $1 for this 62.5 strike. And then I would look down here going into November and look at trying to collect another $1, which is about 57.5. So see how you would be scaling this in. you would be buying this one at 62.5. You'd be able to buy this one at 57.5. And then down here, going in December, collecting another $1.55. So it's a scale-in buying strategy. And this is a strategy that institutional investors use quite often. They scale into buying, and they use options to facilitate that type of trade, because if the stock never gets down there, if you just put in a buy order at 55 and it never got down there, you were never able to buy it, so it never really did you any good. Whereas if you put in this order for selling the puts, you can collect the premium. So you're keeping your money at work. Now keep in mind, you need to have it in your head that you might have to buy these stocks. So you need to have the margin in your account or the ability to buy these stocks and add them to your portfolio, because ultimately that is what we want to do, is to add some of these stocks that are at a price extreme and have value to us and our portfolio. So keep that in mind. The margin requirement that, say, Thinkorswim or your broker is going to charge you is a lot less than the amount of money it's going to take to actually ultimately buy these stocks. So you have to have that in your game plan as well. Now, I don't really want to buy Caterpillar, because one of the things I look at also is, the delta. So that looks pretty good. I would not mind owning Caterpillar had they not just decided to lay off 10,000 workers. And they're a very global company, and I add into my thought process also. I mentioned, I talk about geopolitical and economic analysis. It's a global thing, and right now I don't see China doing very well. Brazil, not that they're a big buyer of Caterpillar, but China is, and some of these major countries throughout the globe are not doing very well, in the United States included. So Caterpillar might not be the best one for this type of situation. So I went through and looked at Caterpillar, and I also look at support resistances. You can, with the Fibonacci, just because I look at it like a lot of people look at Fibonacci, so it has a tendency to come to fruition. So as you can see, Caterpillar is right around the 50% and blew through that. So I wouldn't want to buy Caterpillar anywhere above this retracement here. So this 61.8. So this one doesn't really look good to me. Plus, I would probably want it to come above this trend line here. So that one's not looking very good. But I looked at several of them. So throw out to me what you guys like in that questions box, because I like this to be back and forth with you guys. Some of the ones that hit 52-week lows were Tyco, Macy's, Apache, Caterpillar, Deere, Cummins, Yahoo, Monsanto, Kinder Morgan, Qualcomm, Seadrill, Bed Bath & Beyond, Freeport McMoran, Hewlett Packard, Pfizer, Rig, U.S. Steel, Win. Any of those you guys want to look at? Those are some of the ones that I looked at that have a pretty good volume. That's the other thing. The bid ask is going to be a little off because the market's closed, but I look at something where there's only like 15 cents between the bid ask. I also go back and look at the volume and open interest, because I want something to have a lot of volume and open interest, because when the going gets rough and the market starts moving around a lot, these will get even wider. So make sure that you're picking a stock when you're doing this strategy and something that is pretty liquid, because to get in and out can cost you a lot of money. All right, Jess says Win has been having a lot of fun lately and trying to take me down. I don't know if you watch the daily market commentaries, but I just got playing around with Win, and as you can see, I mean, I think that Win, I don't know why Win is doing so bad. They did miss earnings not too long ago. That was a while ago, but you know, Win just seems really oversold to me too. So this would be definitely something I would look at. I'd like to look at the on the weeklies, and as you can tell, it's at a multi-year low and just fallen out of favor. But as far as I'm concerned, I've gone to Vegas several times and I love the Wynn. So I think they have some of the better bars and one of the nicer hotels there anymore. So I like Wynn. So in regard to Wynn, I would probably look at this and say, all right, the 50, it's trading at 58. So we'd go back to the monitor here. And yeah, see, I even have it up here on my watch, my list here. So when, I would, like I said, look at the volume and open interest. I mean, I know that Win has a tight bid-ask spread, even though it doesn't show it very well here. It's usually a little bit tighter than that, and almost usually like a nickel. So that would fit that parameter. We got a lot of volume and open interest. You can even probably scale it out to November, see that there's a lot of open interest and had a lot of volume going through. So that fits everything. The next thing I would look at is go to the delta and the gammas, or the deltas more importantly. The gamma is very important, but not really for this particular strategy. Because we're going to, if you've watched any of my other webinars, you know that I like to get out 50% of max profit on any given strategy. In this strategy, we're going to look to take this all the way to expiration and milk every penny out of it, because like I said, ultimately, if the stock gets put to us, we're happy to put this in our portfolio at the price that we're looking at. So at Win, depending on how aggressive you want to be in putting this in your portfolio, if you bought Win at 160 and we're down here to 50 and want to, add some at 50, you might be a little bit more aggressive, or 50 some odd, so depending on what fits your fancy, 56, I usually go right around the 34, because 34, 33, because, like I said, the delta is the probability of being in the money. So if you look at this, you can go to probability. Where's my probabilities? So your probabilities are, you got to look at the probability of it being out of the money should be closer to, probability of being out of the money should be a little closer to, a little higher than that, because that's what the real probabilities are, usually 34 to 60, so 90-ish. But that's what I look at. You also can look at this right here, is the volatility index, and this is a high volatility type of, as you can see, Wynn's trying to take me down. So you look at the volatility percentile. Anything above 50 is also a parameter we need to look at. That's what I mentioned in the slides, that we're looking for a high volatility play. So 30% volatility is not going to be one that would fit the bill. This one's got high volatility, anything above 50, because the reason why we don't want to sell this option and then have volatility expand on us, because that will cause us to, our premiums to go higher, and that's never any fun when the premiums pump up on you. And with this strategy, we don't want to take in 500 shares of Win necessarily. So to scale in on when volatility is expanding on you doesn't really fit this one. So as you can, I had to get defensive with this Win on that one, so it's at a full loss, but I wouldn't mind buying Win at these levels, obviously. So when, looking at the 32, which is a 32% probability of being in the money, and a 63% probability of being out of the money. So the odds are, if we put on 3 of these, 1 out of the 3 is going to land in the money. 2 out of 3 are going to land out of the money. So the delta and the probability of being out of the money are inversely related you know, as a ballpark. It's not always exact, but as you guys can see, you know, if it was exact, that would be 66 or 68, right? But it's a very nice trade rule that you don't have to go back and forth, that those are inversely related. This is the probability of being in the money, and this is a probability, and the minus 100 is the probability of being out of the money. So go back to delta and gamma. So the probability of being in the money here is 32%. So I would look at that one. So we're collecting $1.68. If it gets to 55, if we go to the chart, it gets to 55, that's quite a bit below this. So that would be a pretty good place to go, I think. And I would feel comfortable there. So we collected, so this is where I go with this. I looked at the 33 delta. So we're looking at about $1.70, just say for math. It'd probably be a lot better than that, but $1.70 there. And then I'm going to be looking at collecting around $1.70 here. So up there we did the 55s. We could do the 50s here and collect $2, and then go down here and get 45s and collect another $1.50. So and that would scale it in. You'd be buying it every, you know, $10 lower than your original price that you'd want to. Sorry, this was playing around with. So the way to do this, I don't want to do 10, 20 shares of this because I don't want to get filled on all of those. I don't want to take all of that. So you go down there, and then we did the 55s. I'd probably do the 50s here, and it's going to keep defaulting me. Oops. You know, if you have deep pockets, you might want to do 10 lots. But keep in mind, you're doing 1,000 shares of the stock because each one lot is 100 shares of the underlying. For those that, and to add these in together, you have to hold down the control button and then click on the sell side of the option chain for the puts, just so that it combines them all. And see, we're going to be collecting $5.49 for this. So if the probabilities of one of them landing in the money, we've still collected this $5.49, and we're getting the stock where we wanted it. And if it doesn't ever meet those, and the probabilities don't work out that way, and none of them land in the money, and we don't ever have to take the stock, we've still collected this $5.49, which is really $549. So that we get to keep because we took that risk. Does that make sense to everybody? And keep in mind, you know, full disclosure, I do have positions on in some of these stocks. I'm not trying to get you to buy it, to pump it up with one lots and options. It's just the nature of the business. So something else we could look at. Anybody else have anything they want me to look at real quick? Where I start going into a list. I thought Macy's looked pretty interesting. If we go to, just because we're coming into the Christmas season. Why buy them all on one ticket? Is that Aon? Do you mean Aon the stock, Jess? Or why not just wait to do it on? Why buy them all on one ticket? I don't know. That's the way I do it. When I come up with it, one thing that I don't try and leg in and out of spreads for the most part. For one, to me, it's a waste of time for the most part. And when you try and leg into spreads, it's generally, you know, you're going to win 50% of the time. You're going to lose 50% of the time on legging in and out of spreads. But the times that you lose on legging it, the stock may have a move, and you're going to lose more money on the 50% that you legged it incorrectly or legged it bad than the times that you legged it better. It's just from my history of trying to leg in and out of spreads. When I was on the floor, it was a lot easier. You know, I knew that if I got hit, boom, I was going to be one of the first guys to hit the offer. And this day and age in the computers, they're a lot faster than us. And that stuff just can't happen. It's just going to go really quickly. Yes, you do need for when you would, but for so Andreas is saying this means we have to have $20,000 in account just for this stock. Yes, if you don't have the money in your account, win would not be the one that I would be playing around with. That was just something that somebody threw out to us. That would, you would go then to maybe something like U.S. Steel. If you thought that U.S. Steel, we can look at U.S. Steel and see that it is at a very low level. Even right here, this chart shows that 25 back in 09 was at the low, but this stock has gotten really pretty beaten up, especially lately. So you could do something in U.S. Steel, which is X. What was the other one that I was going to look at? Rig, which is Transocean. It's gotten beat up also, as most of these type of stocks have gotten really pretty beat up. So Rig is another one I would look at. There was another really good example. I thought it was like it had gone to $7. I thought on my list. So these would be pretty good. Jess asked, do I think it would be better to execute by putting it on 3 tickets? It might be. I usually kind of just put it on the 1 ticket and do it. You might get a better price here and there if you do, because it might, that's a great question. I usually don't. I probably should look into that, because the more I think about it as you bring it up, it could route it just to one exchange, and you might be able to get a better fill at another exchange. So that is a possibility, or a possible thing to do. Usually with these types of things, for a couple of pennies here or there, I'm usually thinking that if I send it all out, I can move on to the next thing, and I'm going to get a better fill. I don't have to worry about the market moving on me and stuff like that. So you might be able to get a better fill if you put it on 3 separate tickets. That is something to look at for sure. And because you brought it up, it might be a good one to do. So I'll look at it. And Jess, are you asking me to look at RAD? R-A-D? Oh, they got, so yeah, this would be another one, $6 stock. That would be something to look at. So they've sold off quite a bit. I would have to say that this looks like it's at a support level. So that would be something that would be, I would look at. So let's throw on the fib, 2 cents. Up to 9 something. So I do this just because, like I said, and I'm just ballparking it for time. I'm not going to get it exact. So something of, $6 would be a great support level, I think, to look at it. So let's see if we could get the options to support that. So we're looking at $6 for, so $6 looking pretty good. 27, I mean, you're only going to get 6 cents for it, so it's not really going to lower your cost basis a whole lot, but it works. It's a very low stock right now, so that would be something I would definitely consider. So you can get probably 8 cents mid-market. Always go in at the mid-market. And sometimes you can go even a little higher than the mid-market and scale it in. You shouldn't throw it in there and hope you get filled on the first time. I put it in, lower my incrementally go lower to find price discovery. Don't just bang it out. So then you could get it at 6, at 5, and again hopefully at 4. And definitely on this type of scenario, especially when you're getting very little for that stock, for that premium in that, this would be something like Jess mentioned. or Jess, you mentioned, to put this type of trade in on several different tickets, because you probably will get an opportunity to get a couple pennies, and those couple of pennies in a stock like this would definitely make a difference in your return on your investment. So that would be a definite example, Jess, perfect example to put these in on 3 separate tickets. The other thing I would look at is, since the market's closed 4 cents wide, it's pretty good. So let's look at the volume and open interest. Oh yeah, there's plenty of volume and open interest in here. So this isn't something I trade a whole lot, so I will add that to my list there too. All right, going forward, asking about Southern. Yeah, you know what? This did pop up on my list that I was looking at also. It is kind of all the energies are just getting crushed. Oil prices are so low. China's not going to be buying a lot of energy. So these are pretty tricky. It's trading at 12. What was the historical look on that? I haven't looked at. Yeah, I mean, that's at very historical lows. So this would be a price point that I would be looking at for sure too. Let's look at the options chain. See, volume and open interest is good. The bid ask, even after at this time, is 4 cents wide. So that's 3-4 cents wide. So that's good. So we would have to look at our deltas, and I'm on volume and open interest. So the delta I'd be looking at is right there at 12. So you're looking at $1 lower. The expected move for the entire month is $1.56 plus or minus, and down here it's $2. So you can assume that you have a decent chance of getting filled on this if you really wanted to add it to your portfolio. 33 cents on that, so you could lower your cost basis to, you're basically, if you're doing the 12 strike, you're basically buying the stock at $1.67, or sorry, $11.67. $1.67 would be a bargain. So if we collect 33 cents there, we'd be looking to collect 33 cents here. So we do the 12 strike, the 10 strike, because I like to keep my money the same. I only picked 33% in the front one, and then follow that with being consistent, or as close to consistent with the premiums I collect. So the deltas, as you can see, I'm not always buying the 33 delta. It's usually going to scale down on those deltas and increase the probability of staying out of the money. Because like I said, we really want only one of these 3 to land in the money and take possession on it, rather than all 300 for the most part. At least that's the way I play it. If you want to be a little more aggressive with it, you can, but the idea is to scale down, buying 12, buying 10, buying it at 9. So does that make sense? So that's how I started out my thought process on that. So buying it at 12, like we looked at this, buying it at $12 is, for the most part, the historical low, $12. And if you can buy it anywhere below that, then that's good. And I don't see these companies going out of business. U.S. Steel may, I mean, they're on a death spiral too, but I don't see like Transocean, all of these. It seems like a pretty good opportunity to get into these as well. Rig is one of the ones is my favorite, so that's why I was looking at that. I'm gonna put yours in there also, but so ITB. Okay, you paid $1. Okay, so ITB weekly options. You paid or on October 9th to buy 36 call strike. I paid $1.70 for it just 2 hours ago. What are the chances it will make a bit of money? So let's look at it. I never buy options, just so you guys know, unless I can finance it by selling a call or selling an option. I'm sorry, because you're fighting that theta decay. Remember I said in this strategy, theta is our friend. Theta is this time decay, and every day we get closer to expiration, this is eating away at it. So theta, in a sense, really starts picking up the closer you get to expiration. So from 45 days to 10 days, and even 10 days to 7 days, it really gets steep. So the overall, let's see if I can write on this. So the overall theta curve is going to kind of like look like this. So it starts out slow. Theta starts out, sorry, my mouse is not, starts out slow, and then it drastically drops off. Now this is like within 7 days right here. And this is about, not a very good, I usually have a chart of it for the most part, or a graph of this. But theta starts out not really losing a whole lot of money from your option, but you are now in the area of right in here where you're looking at this. Theta is going to really start sucking premium out of these, especially if you're out of the money. So you're fighting uphill battle. You need your stock to really rally and outpace what your theta decay is going to be. Plus, the closer you get to expiration, this gamma starts increasing. And when the gamma increases, it increases the delta. So for every dollar this ETF goes up, this gamma adds into your delta. So if it goes up $1, this delta is going to incrementally increase every single time. So you're really starting to fight an uphill battle. So you did the 26 calls. So you bought the 26 calls right before this for probably what, 27 cents or something? Oh, sorry, you bought the 26 calls. Sorry, 26 calls. So you bought them for about $1.75, sorry. So you probably bought these for $1.75. Oh, you did the weeklies, sorry. So you did the weeklies and you bought them in the money. Let me get rid of this stuff. Oh, I got my highlighter on. Sorry, guys. First time, I guess, using the thing here. So, I mean, your probability, I can look at what I would look at it, your probability of it being in the money is 82%. That's what you need to look at. That's the way I would look at it. I got an 82% probability of being in the money. And you're going to have, so you paid $1.50 for it. And so you got about, $1.50 is trading $27, so $1.30, $1.20 something in intrinsic value, 20 some odd cents. I mean, you really need this to rally up pretty good, but that's a different story. I'm getting off of the overall. So the one that I really like, and if you guys looked at it before, sorry, I want Bed Bath & Beyond. The other thing that I also look at, I'm not super concerned about earnings, but I don't want earnings to really land in my very front month of the cycle. So since Bed Bath & Beyond just had their earnings, I could probably do 3 months of it never having the next earnings in my options chain. So, if you have it in maybe your 3rd month, then that's a different story. But at the end of the day, this is a great example. It comes out with earnings. They beat earnings. They beat on their earnings. They had this massive rally up and came back off. That to me is looking like a pretty solid bottom. The overall market, you could have your theory there, is bearish. So that's another thing to consider depending on how bullish or bearish you are. But Bed Bath & Beyond has tested this fib level here for the most part, which is really based on this low, which is a support. So, the 60s, if we get it into the 55s on the option chain, that would be something I would really like to add, because I don't know how many of you guys have significant others, but my wife loves Bed Bath & Beyond, and I might as well pay myself back. So 30, it depends on how bad I really want this. 59 on the chart is really that 30 delta, and we are right there at the 59. I would be looking at probably taking possession of it rather quickly, but that's something to consider. So 59s or the 58 and a halves, getting about 45 cents for it. So 45 cents there, and then I'd come down here. So we bought that for 45 cents. I could get it at 56 and a half there for 40, or maybe even 56, let's say, going for that one. And then going down, oh, I had the weeklies up. That's why that was getting a little funky on me. I don't really do this in the weeklies. I usually do this in the monthlies. So in this one, I'm going to go backtrack. The 35 delta is 58 and a half, which is much more appealing. 58 and a half, 55, and then you'd be able to scale into the 50s. So that would be nice right there. Like I talked about, that 55 area is kind of the sweet spot. I think that it would really hold support there. So I wouldn't mind buying it here, and then maybe even buying it again here. Likelihood is it'll come down here, test this, and come off in that time. And then, thanks, Jesse. I'm sorry, I realized I kept that weekly up. So that's why this one really is enticing to me, because if I bought it once, I could buy it again. Wouldn't mind that, especially at this 55 level. And then, I would hopefully keep the premium on at least the third one. But, the probabilities being in our favor, we could collect the premium for these two and then get filled on one and lower our overall cost basis on that trade. So that would be something that I would look at doing. That was the one that really stuck out to me the most, was with Bed Bath & Beyond. The other one I think that I would really like to do is Transocean. I just think it looks like it's kind of bottoming out here, and how much lower can it really go? It's like if you were to buy this stock, the other thing is like you're buying an option. So why not just sell some puts and collect the premium for it? So I would want to try and buy it right in here. I mean, it's found a bottom, bounced off of it nicely, and it's made a higher high. It did make a higher or a lower low here, but I think that if it can stay above here, it's going to look pretty good and have that as support. So that's what I would really be looking at. Anybody else have anything else that they want me to look at going forward? So like I said, that's one thing I look at, where I perceive there being support on a stock that's had a 52-week low or a multi-year low, and then I go in to the options chain, make sure that it has enough volume and open interest, which Bed Bath & Beyond does, Rig is as well. So I would look at those to have a lot of open interest, as you can see right here. Tight bid ask I look at, this has got a nickel wide, so that fits the bill. And then I tried to yes, Andreas, I will almost never buy options. The only time that I will buy an option is if the implied volatility, which I have over here, is like below 30. And as you can see, almost all, I like selling them. So and right now in this type of environment, it's hard to find. And the reason why is when you have high implied volatility, if you buy that stock, you can be directionally right, but as vol comes out of those premiums, the premiums shrink really quick. So to me, you know, when you're buying options, you're swinging for the fences. When you're selling options, you're going for singles and doubles and sometimes triples. So but you're never getting a home run necessarily. So, but that's the way I've made money from selling options, playing the probabilities. You know, if you can play the probabilities consistently, you're playing like you're the house. When you're selling options, you're the house. It's like, would you rather sit at a table and know that the odds are against you for winning, or would you rather be the house and know the odds are with you? And the other thing with selling options is that, you know, you have a multitude of different stocks. So it's like the casino has blackjack, baccarat, craps. They know that if they have more different option strategies in a sense going on, then they know the probabilities are in their favor and something's going to work out over time. So I prefer to sell it. I play the probabilities, usually around that 30%, because I know one time out of three I'm probably going to get hurt, but those other two times is going to make up for it. And you know, there's also defensive strategies you can add to it to increase your probabilities throughout that. You know, if you go and look at some of our other webinars, I go into all of that. So I don't want to get too off track again. But you know, in regards to this, yes, I'm an option premium seller, and the reason why is because I want the probabilities in my favor. I want to take advantage of that, rolling that rock downhill and that theta coming out of it. And when you play with a high implied probability rank, or implied volatility percentile, I should say, when that ball comes out, these premiums just, you know, you'll see them go away quickly. I mean, the premiums just contract very quickly especially when you get inside of, you know, 35 days, and then all of a sudden volatility contracts. These premiums suck out really quickly, and that's something I want to see when I'm selling option premiums. So, you know, that's how I play it. And I will, you know, if I'm going to buy a stock for directional, or buy a option in an underlying, then I'm always looking to sell premium against it to collect money for it, so I can get it for free. Does that make sense? I'm asked if I prefer to sell put options on stocks that are making new highs. Sure, I will go through videos. Thanks. Well, you know, you can sell calls and stuff like that. You know, this is something where you want to take possession of it. So, but also on the videos, I talk about selling iron condors and stuff like that too. So we've gone through a lot of different ones that, and you should play all of the different strategies. I'm not saying this is the one that you guys should all be using. And I'm not saying that you should just use call spreads or put spreads or iron condors, because like in the iron butterfly, when we talk about how you can manage the iron condor if it's going against you. So if you guys are big iron condor traders on option strategies, I talk about ways that you can get defensive on a strategy that's going against you. So those are something to look at also. But anyway, so rig would be something I wouldn't mind owning, especially down here at you know, 10. So this would be something also I would look at. So keep that in mind. Go through the process. Look at I don't know if some people don't look at the charts. You don't have to. But if you find a stock that you really want to buy, then start out with your delta of somewhere between 30 and 35-ish, and start with that. and look at the premium. You can collect 60 cents here because that's mid-market, and then just go down the option chain and look at the 60-cent strike and collect a little bit more for the 10s there. So you would be buying this at, 11 and a half, 10, and then at 8. So it's just a way that, you're scaling into buying, and it's not like you're putting all your eggs in one basket either. So, the way to do it is when you buy a stock, you have to lose money to buy that stock. You guys understand that? Like if I'm buying a stock at 25, in order for me to get 25, it's going to trade through me. You immediately lose money as soon as you buy something in a stock like that. So same thing with the premium. If I'm getting hit on it, it's because I'm going to lose money for at least the next 5 minutes before somebody else comes in and bids it higher. So in order to get filled, you got to get run over, is what a famous floor trader used to say. We used to ask him, he'd get hit on something, he'd get hit on it a little bit lower, he'd get hit on it again. And it was like, when are you going to stop buying? He was like, you guys, in order to get filled, you got to get run over. And that was one of the first things I learned down on the floor. You're right. You don't just pull your hands away when somebody's coming to hit you. If that is your thought process, that's what you want to do, you got to keep that in mind. In order to get filled, you got to get run over. So that's part of investing. That's, you go and you want to buy a car, you drive it off the lot, you just lost $2,000 in the value of it. So, I mean, not that that's an appreciating asset, but in order to get filled, you have to get run over. So that's the way you have to look at it. Yes, today's strategy is to actually add stocks to your core portfolio. So this is something that you would want to end up adding to your overall portfolio. So I'm not saying that this is the end all and be all, but the fact of the matter is if you want to buy a stock to add to your core portfolio and then ultimately end up trading around it, then this is a way to buy that in rather than going in to just buying that stock and putting a bid if RIG is trading at 12.50 to go in and put a limit order in at 10. This is a way to collect premium over time and ultimately end up being able to collect premium or take that stock that you actually want to buy it. Does that make sense? Does that make sense to everybody? Okay, good. So that's ultimately the idea behind that. Is this is something that, I trade mostly options, but I do have a core portfolio of stocks. And this is the way I look at it, adding stocks to my core portfolio. So you have to know that when you're doing this, this is something you want to add. I do a lot of other strategies that I'm trying to collect premiums for also, but those are the strategies I don't want to take into my portfolio. Kind of like we were looking at that win. I was looking at that as a play to collect premium on that, but that wasn't something I wanted to put in my portfolio because it was a defined risk. I sold the 60 puts or I sold the 61 puts and bought the 60 puts, meaning that if it goes below 60, I'm out. I don't want anything to do with it. This is ultimately something to add to the core portfolio that you're not going to really touch. You're going to stick it away and have that, like a lot of people have with, Apple. You could do it with Apple also if you wanted to buy Apple at a certain level. Collect that premium and at the 30 some odd level. And if it gets there, then great, I get to keep Apple. I want it in my portfolio anyway. Then you collect the premium for it and you get the stock. So you'd be buying Apple at 110 rather than you'd almost be buying it at 109 rather than 111, but you collect the premium. If I don't get hit on it, then I collected the money. but this is just a different way of doing it rather than going to the market or putting a bid in below the market to try and get something on a bounce. Some of the best stocks I like is BB. The stocks I like the best are BBB or Bed Bath and Beyond. I'll just say that. Rig, I like Rig down here. Monsanto is a little bit expensive, but Deere I really like at these levels. You know, Deere is still kind of pushing lower. I like Deere more than Caterpillar. Deere has a lot more farmers in their pocket, so and I think that the farmers are going to have a banner crop this year, so they are going to be, despite the fact that commodities are much lower, they're going to have a lot of money. So they like, if you've ever known a farmer, farmers have more toys than anybody. So, and they love going out and buying a $200,000 combine when they got the money to buy it. So I think that will help Deere. They aren't as into the mining and as into China as, say, for instance, Caterpillar. So I would like Deere a little bit. Sorry, I thought I pulled up Deere. I like Deere a little bit better, even though that they've been kind of getting beat up also. They've been pulled down from the news on Caterpillar. So I like Deere at this level. And as you can see, I mean, they've done pretty good, but they've totally been beat up lately. So I'm also a contrarian. So somebody threw out there they don't want to be a bottom feeder. Well, at the end of the day, I'm not the one that runs with it and keeps buying the stock when it's running up. I'm the one that when there's blood in the water, that's when I want to be involved. Or if they're buying it up and it's euphoria, that I'm more of a contrarian type trader, because especially right now with these this massive sell-off, the puts are really getting pumped up in Deere, so you can get further away from where it's trading, collect much bigger premium, and when this implied volatility sucks out, then that premium will also get sucked out. So as soon as this starts contracting, those premiums go down and you're going to be able to keep more of that. So that's how I play this particular strategy. That makes sense for everybody? What is the reason to have a portfolio? I trade futures, Forex, and get in and out. Each day comes with a new possibility. Yeah, to each his own. Some people, like to have that asset in there to keep that money working. If you are margining yourself out with Forex, then that's a whole different mentality. This is a way to add it to your portfolio. If you don't really want to add stocks to your portfolio, this isn't necessarily the strategy to do it. So this would be a way to add a solid stock, maybe a blue chip stock or something like that, to a portfolio, and you can use that as margin as well. So that's, a lot of people have a portfolio of stocks that maybe in your IRA or something like that. Yeah, our website is protraderstrategies.com. We're going to start wrapping this up. I've gone a little bit over time, but protraderstrategies.com, as a matter of fact, in the chat box, there's a link to our website and to a deal we're doing for you guys that joined us on this webinar and participated in it. You're going to get the daily market commentaries. Every day I do a daily market commentary, and I talk about all the different strategies that I'm using, or that I've talked about in these webinars, with call spreads, conversions, poor man's covered calls. So we're implementing these strategies in these videos. I don't have as much time in those daily market commentaries as in a webinar and really drill down on like the deltas and the gammas and stuff like that. But I talk about what I'm seeing on a daily basis, at that given time in the day. So, and putting on and taking off and talking a little bit about my rules as to what we're when to get in and when to get out. And we also do the options trading lessons videos, and they're a little bit more condensed, about 15 minutes for running over different option strategies. Again, they don't go in as great detail as we do in the webinars, but it's nice to go back, get a little refresher, and you don't have to watch the full hour over and over again. But if you wanted to look at a particular strategy, you can go back through that archive and find that. I go all the way back to the beginning of trading, and from Melise from Elitis, which was the first person to implement options using the olive presses and stuff like that. So, and Aristotle even talked about him in one of his books. So then I go on to talking about these workshops where I really drill down on it. I go into detail as the theta, the deltas that I use, what I'm the time when I'm looking to get in. I go into the details of the implied volatility rank or implied volatility percentile, and on each strategy when I get out, because I don't ride these all the way out to expiration. A lot of times I'm going in to a percent of my max profit, and I go into detail on which ones when I get out, if it's like 3 days and 20%, and then I might get out of that particular strategy. Somebody's asking, do I give trade alerts? I can't give trade alerts because I can't give a recommendation. What I do on these webinars is, on these daily market commentaries, is tell you what I'm looking at on that day and what I put on exactly. So I tell you the price I put it on, and a few days later I take it off. Then I say, hey, I'm taking this off. So if you're watching those daily market commentaries, you can, if you choose to implement that into your portfolio, then you can keep an eye out for it when I take it off. So for instance, I just did a Caterpillar trade the other day. I'd rather be lucky than good. I sold a call spread right before they came out with that announcement of the layoffs. So I took it off the next day because I hit a percent of my max profit. Thanks, Eric. You're welcome. All right. Seems very useful. Seems trading stocks is not only buy and sell. There is something to do with the mentality, as you said. Yes, thank you. Right, exactly. This, and we're not necessarily wanting to get hit on all of these. Like I said, this particular strategy is something that we see at a perceived extreme, and we want to buy it and then let that ride out and maybe sell it later at a higher price, if we get that opportunity. So, or collect the dividends because it's a nice dividend paying stock, so that's where you're implementing this strategy, not necessarily for a scalp or something like that. I talk about those kind of strategies in other webinars. This was something I see a market sell-off coming, and I think that there's going to be a lot of stocks out there that are going to be ripe for the picking, and be able to put in to your portfolio of stocks and make some nice money on the rebound. So that's all I got for you guys today. Like I said, you can check out that link in the chat box for that special promotion. And in later webinars, we're going to be drilling down on different options components and how to trade. Like we're going to be talking about calendar spreads and stuff like that in future webinars, and drilling down on the mechanics of that. You can go to protraderstrategies.com and follow this link, or like I said, in the chat box, there should be a link in there. And if you have any questions, you can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. I want to thank you guys all for sticking around a little bit later today, and I hope you all have a great weekend. I appreciate all the back and forth and all the compliments. Thank you. You're welcome. And if you can't take that, take it easy.